Good morning, everyone. So I'm going to go old school with a bit of paper, so bear with as we start to flick over the pages. So for those of you that don't know me, I'm James Baugh, and I head up European market structure for TD Cowen, a fully owned subsidiary of Toronto Dominion Bank. Prior to that, as some of you may know, I held a similar role at Citibank, which followed 12 years with the London Stock Exchange as head of sales for their secondary market business, which included Turquoise. I've been very lucky to have had a long-standing relationship with my colleagues here at the Johannesburg Stock Exchange, so it's an absolute privilege to be invited to address the conference this morning, especially as I know there are many more qualified people here in the audience to be stood up here than me. But first, credit must go to our hosts for recognising the global impact market structure changes continue to have on equity markets in South Africa, and for providing today's platform to debate and discuss the ever-changing liquidity dynamics and asking that important question as to what the broker model of the future looks like. Here, given my experience and my exchange background, I'll be focusing more on the execution business rather than the myriad of other important stuff that banks and brokers provide today. So to kick off, I want to make the important point that market structure and liquidity dynamics in South Africa are really not that dissimilar to those felt in other markets, and particularly in Europe. South Africa has not been immune to global macro conditions impacting other financial markets. Notably, last year's rebalance of the MSCI Emerging Markets Index and the reduction of South Africa's weighting led to an increase in sales of South African securities by international investors as they look to reduce their allocations. In addition, brokers and non-resident brokers with access to international markets have been increasingly sourcing liquidity in dual-listed names offshore. They are doing this in markets where there is both greater liquidity and lower implicit costs relative to the local market here in South Africa. They then go on to sell onshore to their domestic clients, which has also given the impression of a sell-off, when in fact this is actually driven by local demand for these dual-listed securities. The second panel after lunch will no doubt shed more light on how fragmentation is impacting the way dual-listed securities are traded. But those changes in market dynamics seen here, as I said at the outset, are certainly not that dissimilar to those felt in Europe. This is not only due to their ever-present global, or those ever-present global macro conditions, but also due in part to the interconnected nature of our markets. Liquidity has been increasingly harder to come by, with the daily turnover of cash equities in value terms down around 10% across both regions in 2023. And if you just measure intraday on-book liquidity, the decline has been even more acute. Perhaps one shining light here has been the growth in commodity ETFs, encouraged by an increase in global commodity price volatility and to a lesser extent the continued growth in passive indexation. In contrast, and in reaction to a lack of intraday liquidity in the cash equities markets, we have seen an increase in closing auction business. This, for example, now accounts for around 25% of the day's notional on both JSE and on the London Stock Exchange, albeit perhaps a little higher in London compared to the rest of Europe. But as we all know, this can be upwards of 50% on those index rebalance days. In an effort to plug that liquidity shortfall, in Europe at least, we have seen an increase in alternative liquidity sources and bilateral liquidity provision over the last 18 months or so. More business has been consumed by systematic internalizers or executed over the counter. This trend has resulted in the concentration of business towards fewer, larger global banks and brokers. For example, in Europe, we now see around a third of the day's close business internalized by a limited number of those global banks. This has ironically counted towards a 20% plus increase in bilateral liquidity provision since the introduction of MiFID II back in 2018. In addition, we have seen a notable increase in liquidity providers and proprietary trading firms providing price feeds direct to the buy side and to underlying retail brokers, which has, in essence, removed this liquidity from the public markets. To qualify this, in Europe today, we see nearly half of the daily turnover of business executed in this way. In some markets, like the UK, this number is even higher. For dual-listed names, when measuring bilateral, over-the-counter, SI and off-book on-exchange business, in totality, this number is currently running at over 37%. This is liquidity we have to consider as inaccessible, as it's only accessible to those with bilateral relationships in place. And keep in mind, this liquidity is not uniform and it's not multilateral in nature. We also face the added complexity in trying to measure the true size and scale of this business due to complex reporting rules. Consequently, there is potential for misreporting of business executed away from the public markets. If you recall, the European regulator's key objective in MiFID II was around greater transparency and market access for investors, not less. Although, to be fair, both the European and UK regulators are now finally addressing some of those reporting rules. Institutional access to retail liquidity remains important in sourcing those harder to trade, less liquid, small and mid-cap names. In this case, the implicit costs of trading can be higher than when trading in more liquid, large-cap instruments. And again, it's worth highlighting, retail activity is also difficult to measure accurately, as it can only be identified when executed directly by a member firm defined as a retail broker. However, we all know a large proportion of this business comes to market indirectly via other member firms executing both retail and institutional business. Despite the increase in bilateral liquidity provision, and perhaps in reaction to that squeeze in intraday liquidity, in Europe, we've seen continued support for alternative dark venues, conditional block platforms, and periodic auctions. All of these can help in sourcing contra-client natural liquidity whilst managing market impact and implicit costs, particularly in a low liquidity environment. This trend towards a concentration of business to fewer larger firms is not a European phenomenon, and I understand it's something that has been felt here too. The number of members on JSE has declined from 61 in 2017 to 41 today, with 80 to 90% of the flow coming from the top 10 member firms. Those numbers are not dissimilar in Europe. The concentration to the top 5 global banks has never been higher. But perhaps this has been further exacerbated in South Africa by restrictive infrastructure costs for local brokers to access overseas liquidity, particularly in those dual-listed names. This also extends to international securities in the wake of the Regulation 28, the 45% ruling, which, as we all know, has enabled pension funds to increase their holdings in foreign companies. The complex and fragmented nature of equity markets, particularly in Europe, makes this even more a challenge for domestic brokers here in South Africa, and I'll look to address this a little later. So, given this concentration of business to fewer larger firms and the ever-evolving and increasingly complex market structure, what do we think the broker model of the future looks like? Appreciating today's agenda has been carefully put together to hopefully provide some answers. To set the scene, I decided to follow my teenage children's advice, and I've asked Google, and also ChatGPT. Right. In any case, I thought this would be a surefire bet, not only to impress you, the audience, by showing off my generative AI skills, but to read out some of the more wackier responses to hopefully get a few laughs, so don't hold back. But to be fair, firstly, I actually had to ask somebody in the office how to do this. bit embarrassing. And secondly, I was actually quite bowled over with the answers I got. So here we go. First, Bard. For those of you that don't know, like myself, that's Google's equivalent to ChatGPT. So Bard confirmed, and I quote, for compliance purposes. That was the first gag. Okay, it's tough audience. This could be a long 10 minutes. Right. So Bard confirmed. The traditional agency broker model for trading equity faces significant challenges and opportunities in the coming years. So challenges and opportunities in the coming years. Predicting its exact future is difficult. Well, wow, there you go. Bang on. Okay, so now ChatGPT delves a little deeper. And this is actually all quite serious stuff. Unfortunately, not many more gags left. So delving a little deeper, ChatGPT, and again I quote, "The future of the equity broker model is dynamic and multifaceted, driven by technological innovation, regulatory changes, and a heightened focus on client-centric services and risk management." And here, importantly, it states, brokers who adapt to these trends will be well positioned to thrive in the evolving financial landscape. It goes on. The equity market is becoming more interconnected globally. Agency brokers will need to expand their capabilities to provide access to diverse markets, requiring a nuanced understanding of international regulations and market dynamics. Who'd have thought? Increasing reliance on data analytics for real-time market insights and decision-making. AI-driven tools will enable better prediction of market movements and enhance overall trading strategies. The industry will see more collaboration among brokerage firms, technology providers, and financial institutions. Partnerships will be formed to share expertise, leverage complementary capabilities, and stay competitive in a rapidly evolving landscape. So there we go. Gripping stuff. So now picking up on a couple of those themes, including a heightened focus on client-centric services, adaptability, a greater reliance on data analytics, use of AI-driven tools, and more collaboration amongst brokers, technology providers, and financial institutions, I decided to canvass a number of heads of dealing at some of the largest global buy-side institutions to get their views, and perhaps understandably, they all provided very similar feedback. And what is clear is that whilst we have to accept fewer larger firms dominate access to liquidity, there is absolutely still room for those that can adapt and evolve to provide a differentiated service. Here, your local knowledge, your expertise, and your partnerships are even more important. One dealer remarked, and again I'm quoting, "Local market knowledge always pays off. There's always going to be a place for those specialists on the ground who know the local players, can access retail liquidity, etc." Whilst another said, "Those that succeed will be those that have that local knowledge and the client relationships, but are not shy in forming those partnerships with firms that have that global access. It no longer matters if locals use third-party access or memberships to get to liquidity. Nobody cares anymore. It's those in relationships and local knowledge that's key here." But also, let's not forget, whilst recognizing the need to access international markets, it's also vitally important to maintain and ideally grow those liquidity opportunities closer to home. This was highlighted to me by another buy-side desk head who said, local practitioners should look to exploit this position, not to hold liquidity captive, but aspire to improve the quality of execution and minimize costs to attract and grow liquidity. Improve access and participation by increasing the attractiveness of venues to trade on. That's perhaps a nice segue to highlight the initiatives that JSE are working on in the block space and separately the proposed market access rules. They both recognise the need to offer alternative sources of liquidity and provide participants with a level playing field to access liquidity. This is especially important given the growth in co-location, which is in part has been driven by an increase in direct market access, reflecting the consolidation of business I keep referring to. I think it's worth highlighting, in my experience, including my time at Turquoise and now at TD Cowen, that where we can work together with both clients and venues to innovate and provide differentiated and unique liquidity opportunities, we can all benefit. The second panel after the coffee break on regulation will hopefully dig a little deeper here. Now, speaking on behalf of all agency brokers, there are definitely opportunities to differentiate your business from those larger players. Your ability to navigate complex and fragmented markets whilst outperforming competitors can set you apart from others, particularly when liquidity, or at least like-minded liquidity, is increasingly harder to come by. And to that point, it's not even about accessing all liquidity all of the time. It's about being thoughtful, targeting the right liquidity at the right time in order to achieve those objectives as set out by your clients. One thing we have noticed in the European equity markets over the last year or so has been the increasing influence of systematic participants, those proprietary, more time-sensitive strategies. The impact on performance is felt across each of the execution channels, including in dark MTFs, periodic auctions, and now also in electronic blocks, which we talked a little bit about last year. Our ability to evidence this behaviour and mitigate those impacts has certainly enabled us to differentiate ourselves from others. Understanding the market structure nuances and how they can impact client business is obviously key in determining how to build those strategies and code those algos. Equally important is having access to data and the tools to evidence that outperformance. Here, importantly, the implicit cost to the buy side is what counts, and not the explicit cost of execution charged to the sell side. In Europe, it's this that really determines best execution. No longer can brokers chase a rebate on one venue to reduce their own explicit costs when doing so leads to poor performance and a worse execution price for the client. A lack of direct access to liquidity offshore or even domestically should not be a barrier to doing business in any of these markets. As mentioned earlier, partnering with those global banks and brokers who have the access and the scale to realise lower access fees and execution rates can significantly reduce your infrastructure costs and even your costs of trading. As one buy-side dealer said, they really don't care how their brokers access liquidity. It's more about the relationship and the performance. With that in mind, and noting the final panel discussion of the day on talent acquisition, you may want to think about the roles you need to be hiring for: data analysts, execution consultants, and of course, market structure experts would be a good starting point. And as we'll hear later, maybe even somebody with AI expertise. Well, I hope that's given everybody some food for thought as we look forward to today's conference. Clearly, there's no one-size-fits-all model here, and you may not agree with all that I've said, in which case I'll defer to ChatGPT. Thank you for laughing. I'm certainly looking forward to the first session. I can see they're ready to go, which is going to address this head-on. And with a group of expert panelists assembled, I'm sure they'll have some strong views on what the future of the broking business looks like. With that in mind, I'd like to once again thank the JSE for inviting me to speak this morning. I very much hope you have an informative conference, and if not already, I look forward to catching up with you all individually throughout the day. Thank you.